We now talk about the off-runs and Saga's perspective on liquidity stress testing using an Iceland example. Multiple events summarizes the collapse of Iceland's highly levered banking system in 2008. Key events include currency depreciation, lack of market funding, debt servicing problem, and liquidity shortages. The belief is that the period leading up to the financial crisis was that a bank with a strong liquidity position may attract solvency issues, whereas a strong solvent bank is immune to liquidity issues. Test results show that actual liquidity shortage was much more severe as compared to the shortages which was revealed by the stress test undertaken by Financial Supervisory Authority and the Central Bank of Iceland. Moving into the future, many steps can be taken to improve the management of the solvency risk at banks. The most important step is to put more focus on liquidity risk while uh, we were not paying attention to them in the past. The main reason uh, we are learning this and uh, the main lesson that we are learning from this is that the Iceland bank liquidity stress can generate a solvency crisis. Let's look at events that are related to the Icelandic debt crisis. To develop a better understanding of the summary of specific events related to Iceland's debt crisis, a brief description of the background of the country itself and the banking sector is very useful to understand. Iceland is a small European country with its own currency and open economy. It is very much integrated into the global economic village. However, due to small size of its economy, it was neither effective fiscal power nor the monetary control to save its economy from the global waves of the economic turmoil. It was exactly the case during 2008 global financial crisis when the banking sector of Iceland collapsed. The commercial banking sector of Iceland was nearly 9 times that of the GDP when the financial crisis spread globally. At that time of the crisis, three major commercial banks were Kaupthing, Landbexi, and Glith. Historically, the two main sources of funding for these banks were borrowing, such as syndicate loans, commercial papers, and other borrowings, deposit from financial institutions, such as loan from other banks and central banks. Market funding through deposit from customer was significantly low. However, in response to repeated criticism, the banks increased the proportion of customers' deposit to nearly 40% at the end of 2007 compared to just 28% in 2006. More than 66% of the deposits came from non-residents, and nearly 80% of the deposits were in foreign currency, including euros, dollar, pounds, and Swiss francs. In early 2008, when the global financial crisis was at its peak, the banking sector of the Iceland collapsed due to continuing chronic shortage of liquidity. The financial system of Iceland received several shocks in the week or so of the month of October. Let's look at them. On October 6, the Parliament authorized direct government intervention in the financial system. On October 7, the central bank attempted to control the rapidly falling value of Iceland krona by imposing a peg rate of 131 krona to 1 euro, while the market was trading at 172 per euro. On the same day, Landbexi was put into receivership. On October 8, Glitner was put into receivership. On the exchange rate side, the central bank abolished the fixed peg, which lasted only for one day. On October 6, Kuchom was put on the receivership. During these days, the doors of short-term funding were shut down for these banks, and they were unable to unconditionally uh, serve their obligation. Three banks had collectively accumulated 61 billion of debt. The GDP of Iceland was only 5 billion or so. In same time period, Iceland's economy and financial sector received many shocks. The use of krona for international trade purpose was suspended. Consequently, there were effectively no payments coming to Iceland from foreign countries or going out. Interbank borrowing services serves as oxygen, but in the context of deteriorating condition, many private banks internationally refused to lend to Iceland, which further complicated the situation. Iceland banks were unable to finance their debt through short-term financing, a critically important source of funding. This deterioration conditionally generated a panic among the depositors, and deposit run started in overseas branches of the Iceland Bank. To control the situation from further deterioration, the government announced an unlimited guarantee of deposits in the banking system. Solvency and liquidity scenario. Describe the typical solvency and liquidity scenarios present at Icelandic banks in the deposit period leading up to the Iceland debt crisis. Now, both the Financial Supervisory Authority, known in Iceland as FME, and the Seðlabanki, the Central Bank of Iceland, conducted stress test scenario in the period leading up to the Iceland banking crisis. The FME performed stress tests involving different scenarios and shocks quarterly in transparent manner. The details and results of the stress test were made publicly available. The tests were, however, performed on individual bank and not on the same banking system, involving multiple interrelation with systematic correlation. Also, the stress test focused only on first round of effects and not the subsequent effect. More importantly, the test conducted by the FME and the central bank primarily focused on solvency risk. Liquidity was not addressed adequately. Perhaps the underlying belief was that solvent bank would not have a liquidity issue, whereas a bank with sound liquidity may still have a solvency risk. However, the financial crisis experienced by Iceland showed that proper ex-ante identification of liquidity risk as a result of liquidity risk management would have significantly helped to control solvency risk. The central bank did not perform any specific liquidity risk prior to the global financial crisis except for a late 2007. However, liquidity ratios as established by the central bank for international constitution can be viewed as a kind of liquidity stress test. Banks were mandated to estimate a weighted liquidity ratio, which is weighted liquidity upon weighted liquidity liabilities, on a monthly basis and reported to the central bank. Liquidity assets and liquidity liabilities were weighed by relative coefficients, which incorporated the probabilities of recovery of assets and payment of liabilities. The weakness of the weighting scheme, as apparent from the experience of the banking crisis, stemmed from the fact that assigned weights to individual items might have been appropriate in normal times but not certainly in the stress condition. The central bank did generate a liquidity test for the banks, but in late 2007, when the global financial crisis has already started. Also, the stress test ignored the uniform application of stress scenarios across the banking sector and instead focused on individual banks, the unique risk factors, and general market condition. Some of the scenarios applied included deposit withdrawal, currency depreciation, fall in investment portfolio, and discontinuation of credit lines. Interestingly enough, the result of stress tests performed by FME and the central bank generally showed that major three banks of Iceland were sufficiently capitalized and they could sail through adverse market condition and unexpected loss. Now, shock weight adjustment. How weighting of shock in short-term assets and short-term liabilities are adjusted in a stress test that account for liquidity crisis. In order to develop an understanding on how stress tests for liquidity risk incorporate the weighting of shocks in short-term liability and asset, we need to examine the following three items: source of stress testing, who conducts the test, the type of shocks, which asset or liabilities was shocked, the magnitude of shock, the weight of each shock. The FME and the central bank conducted the actual stress test in this hypothetical example, where they tried to simulate the actual stress and assess the liquidity risk of the bank. So they took the liquidity data, which consisted of loans to FIs, customer loans, investment in bonds, investment in equities, investment in hedge securities, total derivatives, total short-term asset, and total short-term liquid asset, short-term liabilities, market funding from customers, and the fact that liquidity items are not uh, uh, present in the test, and some of the absence created problem. Summation of the items uh, were used to find out the total figures. Bank in Iceland had operations in foreign banks, but they were focusing on key currencies like Euro, USD, and British pounds. Both assets and liabilities presented in the stress test represented a short-term position, 1 year or less. Also, investment in bonds, equities, tradings are classified as more liquid, which can easily be liquidated to raise the funds to satisfy short-term liabilities. Now, the total short-term assets were equal to 68 681 186 million kronas, and the total short-term liquid assets uh, where the short-term liabilities were much higher. Clearly, there was a liquidity shortage in this test. Under normal condition, negative net asset do not pose an issue to a bank. In absence of a bank run, deposits are considered as a stable source of funding. Depositors do not typically demand full withdrawal in a short period of time. Market funding from customer deposit represented the largest total of a single item. Now we look at the FME shock. The stress test conducted by FME given shocks to asset side of the equation to evaluate the liquidity position of the banks in a stressful condition. For example, a negative shock of 30, 25 or 20% can be given to domestic stock price, foreign stock price, bond, krona values. These percent were hypothetical, but they serve as a purpose of explaining the weighting adjustment in the actual stress test. Based on the shock weights, the estimated adjusted values for bond and foreign equities were then calculated. Under the stress test team, adjusted bond value of krona was 85% of the base value, and adjusted domestic equity value was 70% of the base value. Despite a negative shock of 15% of the bond price, and adjusted values in foreign currencies were higher than those of the base value. This is possibly due to the depreciation of krona. Regarding the euro, the original investment in euro denominated bonds uh, was shown. Due to a 15% shock, the bond values declined. However, the result of a 20% depreciation shock it again moved the bond values. Similarly, the foreign equity investment were readjusted based on weighting and shocks of 25% and 20% decline in foreign equity and krona values respectively. However, due to higher shock weights to foreign equity, the adjusted value turns out to be lower than the base values. Note that the depreciation in krona brings more krona home after the sale of bonds and stocks denominated in foreign currency. The FME stress test did not shock the liability side. However, recreated the stress test assumed that shock to all short-term liabilities except customer deposit, which develop a strong shock scenario. Now, combined FME and central bank shocks. Unlike FME shocks, the combined stress test injected shocks to both asset and liability side. In the event of overlapping between FME and central bank shock, the shock with higher weighting were used. For example, if FME stress test injected a negative shock of minus 15% to bond price, central bank used 30% negative shock to bond price. So the combined would be 30%. The shock weighting adjustment methodology is exactly the same as described in the previous case that I just talked about. So if we assume a 30% to a shock in bond price and 20% depreciation in kronas, we can develop the hypothetical scenario. Now let's look at what actually happened. Stress tests for actual shocks involve both assets and liability sides, but weighting of shock is much higher as compared to previous tests. For example, if a negative shock to domestic shock price under FME stress testing is 30%, the actual shock scenario may give it a weighting of 50%. The shock weighting adjusted method under replication actual shock scenario is exactly the same. So comparing the stress test methods is something that we are going to now look at. So contrast the stress test method of financial supervisory authority and central bank and compare the result to the resulting funding gap at central bank from actual shocks. So comparison of stress test model. The originally liquid stress test as conducted by FME did not give a shock to liability side of the balance sheet. However, replicated FME stress did inject liability shocks except for deposit for customers, which were considered as stable sources. On the other hand, liquidity stress conducted by central bank gave shocks to short-term assets. The recreated stress test combined the shock applied by the FME and the central bank into a single test. In case of the overlapping of shock, the largest shock was applied. Another major difference in the stress test method of the FME and the central bank was related to weights and the magnitude of the shock. Shock to domestic and foreign stock prices, net for losses, and the currency was same in both tests. However, there is substantial difference in terms of shock to bond prices. The shock given to the bond prices in the combined test was 7 times higher than the shock given in the FME test. Another difference was the absence of shock to domestic and foreign loans. and advances in the FME stress test, where combined test did inject shocks to the items. So comparison of stress test result. If we look at the stress test result on the liability portion of the large Icelandic bank, all the numbers that used saw that there was a funding gap of around minus 580 and a funding gap ratio of 0.87. Similarly, there was a funding gap ratio of 0.37 for the short-term liquidity assets. So short-term assets and short-term uh, liquidity assets both had funding gap, and funding gap ratio is equal to short-term asset upon short-term liabilities. The base case original liquidity posting before the crisis shows a liquidity shortage which intensifies when the focus is on liquid asset. That is the bank's ability to satisfy depositor and borrower short-term claims by redeeming short-term liquid assets which can be sold at relatively easier way, and this deteriorated significantly. That is, a bank can pay off 87 cents for 1 krona of liability when all short-term assets are included. However, when only liquid assets are included, the bank ability to pay off 1 krona falls to only 37 Iceland auras. Now the FME stress test. Gave a funding ratio of 4.37, which is very high, and in both cases there is an excess of assets over liquidity. However, the only focus is on the liquid assets. The funding ratio falls from 4.37 to 1.7, showing a much reduced ability. So combined stress test and the actual shock after the deposit freeze was something that helped us to identify this. Now let's look at improving solvency risk management, and we'll do that in the next session for the same topic.